Every new investor dreams of turning a small amount of money into something big. But the truth is, most beginners lose money not because of bad luck, but because of avoidable mistakes. These mistakes often happen before you even realize it. Chasing hype, panicking during drops, or investing without a plan. It's easy to believe that success in the stock market is about finding the next hot pick. But real success is about avoiding traps that drain your money and your motivation. The market is designed to test your patience, not reward impulsive moves. That's why understanding what not to do is just as important as knowing what to buy. Most investors don't fail because of lack of opportunity, they fail because of lack of discipline. And if you can master the art of avoiding mistakes early on, you'll already be ahead of most people. In this video, we'll uncover the most common mistakes new investors make and how you can avoid them. Whether you're starting with your first $100 or building your first portfolio, these lessons could save you years of regret and lost wealth. Stay with me till the end, because avoiding these errors is the first real step toward financial success. 1. Chasing quick profits. The number one mistake beginners make is trying to get rich overnight. They see social media posts about instant millionaire stocks and jump in without research. But investing isn't gambling, it's planting seeds that take time to grow. When you chase fast money, you're really chasing emotion, not logic. And emotions in investing almost always lead to losses. Quick profit chasing makes you vulnerable to hype cycles, where you buy at the peak and sell when panic hits. True wealth isn't built on one lucky trade. It's built on thousands of smart, patient decisions. The greatest investors didn't double their money in a week. They doubled it through years of consistent effort. So instead of looking for overnight success, focus on learning how markets behave. Understand that the biggest profits come to those who give compounding time to work quietly in the background. Remember, slow growth is still progress, and small wins add up faster than you think. 2. Investing without an emergency fund. Many new investors put every dollar they have into the market, and then panic when life throws an emergency their way. Without a safety net, you'll be forced to sell your investments at the worst possible time. An emergency fund isn't about being overly cautious. It's about protecting your freedom to stay invested. Think of it as your financial airbag. You hope you never need it, but when you do, it can save you from disaster. Even $300 to $1,000 set aside can make a huge difference in how confidently you invest. When you have backup cash, you don't panic sell during a downturn. You buy more. You don't let short-term problems destroy your long-term plan. Smart investors always secure their foundation before they start building wealth. Remember, the first rule of investing isn't make money, it's don't lose money. And having an emergency fund ensures you never have to sell your future just to survive your present. 3. Trying to time the market. New investors often think they can guess when prices will rise or fall. They wait for the perfect entry or sell out of fear when the market dips. But even the best investors in the world can't predict short-term movement. Timing the market feels exciting. It gives the illusion of control. But in reality, it's just guessing with confidence. Instead of trying to catch every wave, learn to ride the ocean. Markets move in cycles, up, down, sideways, and no one can predict them consistently. What separates good investors from gamblers is consistency. Investing a fixed amount regularly, known as dollar cost averaging, removes emotion and builds discipline. It's not glamorous, but it works. The truth is, time in the market beats timing the market. Every day you stay invested gives your money a chance to grow. Stop waiting for the perfect moment. The perfect moment is now. 4. Ignoring research and education. Too many beginners invest in companies they barely understand. They follow tips, social media trends, or friends' advice, without ever checking what the business actually does. This is like driving blindfolded. Investing without research is like betting on a horse you've never seen run. You're not investing, you're speculating. Before you buy anything, learn what the company sells, how it earns revenue, and what risks it faces. Even a half hour of reading can save you thousands. Don't rely on others to think for you. Build your own conviction. When you know what you own, you don't panic when prices fall. Study the basics: revenue, profit margin, debt levels, and market share. Every bit of knowledge adds another layer of protection. Remember, markets reward knowledge and punish ignorance. The more educated you become, the more confident and profitable your decisions will be. 5. Ignoring diversification. Putting all your money into one stock, one company, or even one industry is like standing on one leg. One wrong move, and you fall. New investors often put everything into what's trending, but smart investors spread risk. Diversification is not about lowering your profit potential. It's about raising your survival rate. When one part of your portfolio struggles, another can balance it out. This balance keeps your journey steady, even when markets get rough. Consider spreading investments across different industries: tech, healthcare, energy, finance, and consumer goods. You can even diversify with index funds or ETFs that include hundreds of companies automatically. It's the simplest way to protect yourself from surprise market shocks. The goal is not to hit a home run, it's to stay in the game long enough to let compounding do its work. A well-diversified portfolio might grow slower at first, but it will grow steadier. And that's what builds wealth over time. 6. Letting emotions control decision. The stock market is a roller coaster. Prices rise and fall every day. Beginners often panic when they see red or get greedy when things go up. But emotion is the biggest enemy of long-term success. When fear takes over, you sell too early. When greed takes over, you buy too late. Either way, emotions cloud judgment and lead to regret. Smart investors learn to separate feelings from facts. They follow a strategy, not a mood. One of the best ways to control emotion is to create a written plan: what to buy, when to buy, and when to sell. Stick to it no matter what happens in the short term. Remind yourself, temporary drops are part of the process. Volatility is the price of long-term reward. The calmer you stay, the more opportunities you'll see. Investing isn't about reacting, it's about enduring. 7. Forgetting. About fees and taxes. Every trade, fund, or account can come with hidden fees, and they quietly eat into your profits. Beginners often ignore these costs, but over time they make a big difference. Even a 1% higher annual fee can cost you tens of thousands over decades. That's why experienced investors always look for low-cost index funds and platforms. It's not just about earning more, it's about keeping more. Taxes matter too. Selling frequently means you'll pay more in short-term capital gains. Holding long-term not only compounds your returns, but also lowers your tax rate. The less you spend on fees and taxes, the faster your wealth grows. Remember, small leaks can sink big ships. Guard every dollar, because every dollar you save is one that continues working for you. 8. Expecting results too fast. New investors often give up too early. They expect their money to double in months, and when it doesn't, they stop. But investing is a long-term game. True growth happens over years, not weeks. The market rewards consistency, not impatience. Every dollar you invest is like a seed. It doesn't sprout the next morning, but with time and care, it becomes a tree. The first few years may seem slow, but those early contributions will later multiply faster than you can imagine. Learn to love the process. Celebrate small wins. Even if your returns are modest today, remember that every investor who built wealth started where you are, and small and uncertain. The key is to stay consistent. Compounding is a slow burn that suddenly explodes with time, but only for those who don't quit early. Every investor starts as a beginner. Even the most successful ones made mistakes early on. The difference is that they learned from them and kept going. Don't let early losses or confusion discourage you. The best investors are not the smartest, they're the most consistent and disciplined. Avoid these mistakes. Focus on learning, and remember, wealth doesn't come from luck, it comes from habits. The earlier you start building those habits, the stronger your financial future becomes. You don't need a perfect plan to begin. You just need to begin smartly. Start small, stay steady, and trust the process. One day you'll look back and realize those small, patient steps were the foundation of your freedom. If this video gave you clarity or motivation, hit the like button and subscribe for more lessons on money, investing, and long-term wealth building. And share this video with a friend who's just getting started, because avoiding one mistake today could save them years of regret tomorrow.